How do you calculate your return on investment for real estate investing? You've probably heard people say, this property generates an 8% ROI. Well, what does that mean? Well, in this video, I'm going to share that with you. Not all real estate deals are created equal. Knowing ROI will help you determine what a good or bad real estate investment deal is. Are you really making money on your real estate investments? We're going to look at ROI, return on investment, how to calculate what your true return is on your real estate investments. By the end of this video, you're going to understand what ROI or return on investment is. Secondly, how to compare properties using ROI as the metric. And then lastly, what are the factors that affect ROI on your properties? So what is ROI when it comes to real estate investing? It simply means return on investment. This is what real estate investors are ultimately looking at. Many times we talk about cap rates or internal rate of return or cash on cash return. Those are important metrics. ROI is the holy grail because this is the return on the investment that you make in the property. So for example, if you invest $1 million on a real estate property and you bought that property for $5 million, you borrowed $4 million and the down payment was the $1 million to give you that $5 million purchase price. The ROI is the amount of cash flow after you pay expenses, interest, and then profits. This is the cash flow that shows up at the bottom line after paying debt. This is what you distribute to yourself as an investor or to you and your investors. You divide that number, that cash flow amount annually by the total investment made in the property. So if you generated $100,000 of cash flow your first year of the investment and you made $1 million initial investment, that's a 10% ROI. Now your ROI can increase over time. As you raise rents and each year if your cash flow goes up, your initial investment typically doesn't change. So you can increase that number to 11, 12, 13% by increasing your cash flow each year. If the following year you're able to generate $110,000 in cash flow profits, then your ROI on that $1 million investment is 11%. Where you can get a real boost in ROI is if you refinance the property or you sell the property. This is also called a capital event. So when that sale or refinance occurs and you get a large sum of money through the sale or through that refinance where you're getting cash back from the lender, that's going to boost your ROI because now you got an influx of cash to help pay back your initial investment. So say in year 5, you're able to get $1 million back from what you initially invested in the property by refinancing. You were able to continue to hold the property. That's going to boost your ROI because now you calculate all the cash flow that you generated over the first 5 years of the investment, plus all the money you got out from the refinance. And then that's going to give you your ROI, which typically could be over 100% of what you invested originally. Now you got your investment back. You have over 100% ROI and you continue to collect cash on that investment because you continue to own the property. Those are the best deals you can do in real estate. Leverage, also known as debt, meaning if you get a bank loan on a property, this affects your ROI. So if you have a high interest rate and the majority of the net operating income or the profits that the property generates before paying debt, if you're paying the majority of those profits or that NOI towards interest, that's going to lower your ROI. Meaning, if you're paying in more money towards interest on debt versus profits that are coming out of the property, then you could have a negative ROI where you're actually having to support the property to keep it afloat. This can happen if you don't run your numbers. That's why it's really important to understand what's the NOI and then what's the cost of your debt, and then in turn, what's left over. That's going to give you the clear metric if you're going to have a positive or negative ROI. Operating expenses and maintenance. Very important to look at this when calculating ROI. Many times brokers or sellers, they may take some of the long-term deferred maintenance, or also known as capital expenditures, paving roads, fixing roofs, fixing foundational issues, fixing drainage problems on the property. Many times, a lot of these expenses will go on the balance sheet and you don't really know if they're expenses or if they're continual maintenance items that you're going to need to pay for. And if those things aren't done, then these are costs that you're going to have to incur and you're going to have to add either more debt or more of a down payment on the property in order to cover these costs. This is going to lower your ROI. The more money you invest on a property or the more improvements you make, the lower your ROI may be because that's more cash that you have to invest. and there's only so many profits these properties can generate. So know what are those expenditures that you're going to have to pay when buying a property, and if you're adding in significant improvements, factor that in because it will lower your return on investment. But if you're able to increase rents due to that, then you're going to be able to improve your ROI over time. So comparing ROI across different asset classes. If you have a Class A apartment building in the middle of Miami, that's going to be a low ROI. The price of that property is going to be extremely high and it's going to be very competitive when buying that asset. So expect a lower return, 4, 5, 6% if you're lucky on those types of assets, maybe even less, depending on the climate of the investment community. If you're thinking about buying a real estate investment trust stock or a REIT stock, those typically generate a 4 to 6% ROI. That's based on your investment that you buy for a share of the company, and their dividends or distributions will generate your calculation of your ROI. And they're lower because they're institutional large assets. If you're a value-add investor, just remember that in the beginning when you're buying value-add property, the initial ROI might not be very high because you're going to need to make improvements to increase that in order to get that 7, 8, 10% ROI or profit return on your investment after a couple years after you've made those improvements. And then lastly, if you're looking to get a triple net, really nice property that's a McDonald's or a Bank of America or a credit tenant, know that that's probably going to be a lower ROI because again, that's a low cap rate, high demand property that most investors want. There's not a lot of deals out there that are going to generate a high ROI because so many investors want that type of property and it's such a safe investment. So remember, ROI is tallying up not only the total cash flow you make year one, but whatever period of time you're looking at. If it's a 5-year investment, calculate all your cash flow over that 5 years you own the property. And then calculate, if you sell the property, all the gains that you made on that property. That's going to give you the total profits that you generated from that property investment divided by your total equity, the cash that you put into that property through improvements or through a down payment. And that's going to give you what the return on investment was on that asset. We typically like to look for a 200% ROI over a 5-year period, meaning with all the cash flows, all the profits from a sale, you want to generate at least 2 times your money on a 5-year hold, which averages between 15 and 20% of your investment on average year by year after you've done that entire business plan and held the property and sold it for a profit after 5 years. A 2x or 200% ROI is the ideal target that we look for at Patriot Holdings. Now that you know what ROI is and what type of different assets will yield different ROIs, it's time to look at, is it the right time to sell my property? Check out the next video. How do you calculate when to sell or when to hold a property? I will show you exactly the formula I use when I decide to sell my properties. That way I make the right decisions.